A V pattern is a sharp emotional move. Price drops fast and immediately snapbacks up, or rockets up and collapses just as fast. No slow structure, no consolidation, just speed. What's up everyone, welcome to Immortal Trade channel. Today we are continuing our chart pattern series, and in this video we are focusing on one of the most aggressive and misunderstood setups in trading. Before we jump in, a couple of important things. First, I decided to cover each pattern in a separate video, not because I want more videos, but because I want you to actually understand what you are watching. These setups need time, practice and repetition. Second, if you haven't watched the previous chart pattern video, do not skip it. I know it's longer, but it's foundation. Without that context, this video won't fully click. Now, the pattern we are talking about today is exciting, but not easy to trade. It's called the V-top and V-bottom. Here's the key detail. Most people miss volume tells the story. Typically you will see low volume at the start, a sudden volume spike at the turning point, and then volume fades again. That volume explosion is one of the strongest clues that a V pattern is forming. Let's be honest, there is no perfect confirmation for V-tops and V-bottoms. That's why most traders mess this up. One particular technique is drawing a very steep trend line along the move. When that aggressive trend line breaks, it's often the first signal that the V pattern is activating. Once that happens, the market usually mirrors the move. The size of the drop often equals to the size of the rebound. Targets are commonly measured using risk-reward levels 1 hour, 2 hour and 3 hour. If you don't understand risk-reward yet, pause this video and watch the risk-reward video. A V-bottom after a strong downtrend, especially on higher time frames like 4 hour, often means one thing: the bearish phase is likely over. That doesn't mean price can't pull back, but it does mean the market environment has changed. The same logic applies in reverse. A V-top after a strong rally is often an early warning that the uptrend is exhausted. These patterns don't show up randomly. They commonly form at major historical support or resistance levels, near important Fibonacci zones, around psychological price levels like round numbers, and in rare cases, directly on a trend line. When multiple of these lines up, the signal becomes much more meaningful. Take Bitcoin moves toward the $14,000 level. That price wasn't random. It was major psychological and historical resistance. Price hit that level, volume exploded, then quickly faded. The market printed a clean V-top, and the trend shifted bearish for a period of time. No indicators, no lag, just price, volume and behavior. V patterns are powerful, but they are not beginners friendly. They are best used as market phase indicators, not quick scalp setup. If you learn to recognize them properly, they can help you to spot major trend shifts early. Avoid chasing emotional moves, understand when the crowd is trapped. Another important thing about V pattern is context. A V-top or V-bottom by itself means nothing if you don't understand what the market was doing before it formed. Was price trending strongly? Was the move driven by news, liquidation or pure emotion? V-patterns thrives in emotional markets. When fear or greed peaks, the market tends to snap violently in opposite direction. That's why these patterns look so clean, but are so hard to trade in real time. Also, time frame matters more than people think. On very low time frames, V patterns happen all the times and most of them fail. Noise, algorithms, and stops hunts can easily fake them out. But when a V pattern forms on a higher time frames like the 1 hours, 4 hours or even daily, it carries much more weight. The higher the time frame, the more market participants are involved, and the more meaningful the move becomes. Another mistake traders make is trying to predict the V before it completes. They see price falling fast and immediately try to catch the bottom, or see price pumping and start shorting too early. That's gambling, not trading. V patterns are reactive setups, not predictive ones. You wait for the market to show its hands first. Speed without confirmation is how accounts get wiped. Risk management is absolutely critical here, because V patterns are aggressive, stops usually have to be wider. That means position sizing becomes even more important. You don't trade V patterns heavy, you trade them smart. One bad V trade shouldn't damage your account. If it does, your risk is too high. And finally, understand this. V pattern reflect crowd psychology. They show moments where one side is completely exhausted. Sellers panic, buyers step in aggressively, or buyers FOMO at the top and the smart money distributes into them. If you stop seeing V patterns as shapes and start seeing them as behavior, your trading level will jump significantly. If this video helped you, make sure to save it, share it and drop your question in comments. And again, if you skipped the previous chart patterns videos, go watch it. It's essential. More patterns coming soon. Trade smart, stay patient, and I will see you in the next one.